Hello, welcome to our Expert Talks 20-minute roundup with business owners, industry leaders to gain their insights and how you can discover multiple passive income streams. And today's show is going to be surrounding exchange-traded funds. They have gained in popularity since the beginning of 2020 and they have many benefits. And today we have with us one of the experts from the field, the Executive Director of Betashares, Peter Harper, and he's here to discuss his work with us. And to give you some background, Betashares is a leading ETF or exchange traded funds manager, providing intelligent investment solutions that help Australian investors meet their financial objectives. Welcome, Peter. It's a pleasure meeting you.
Yes, indeed. Thank you, Sage. I appreciate the chance to talk this morning.
Fantastic. Well, we won't keep the audience waiting any longer. I'm sure they're keen to hear from you too. Let's begin. The Australian ETF market has recently breached 100 billion Australian dollars when it comes to funds under management. Globally as well, the numbers are showing a similar trend. What's your take on this current ETF mania?
Look, it's certainly been a strong growth profile for the ETF industry in Australia. I think, as you said, we've reached around $100 billion in assets, and that's a compounded annual growth rate of somewhere between 40 and 50% since the launch of the ETF industry a number of years ago. So it's been a very strong ride. But if we look at ETFs and what they are, in some ways they're just an adaptation of the previously unlisted conventional managed fund or unit trust structure. So the legal structure of an ETF's been tried and tested and been around for many decades. And really what's new is the fact that these products are being listed on the exchange to give simpler and more transparent access. And so if we look at why people are buying ETFs, it normally comes down to a few key tenements that people look for. And that's stuff like ETFs are a very simple investment. They tend to be very transparent, so you know exactly what you're holding. Low cost, liquid, diversified, and they provide access to a lot of different investment asset classes, sectors, or segments of the market. And so if you look at those benefits, you would probably argue that they aren't going away anytime soon. And in that light, it would be my opinion that the growth prospects for the ETF industry look very rosy going forward, and I would probably argue they're still, somewhat in their infancy.
Absolutely, and Betashares has quite a significant amount of that assets funds under management. I think your growth from the beginning of 2020 increased by $7 billion, if I'm not wrong there.
Yeah, that's about right. We had about $10 billion of assets at the start of 2020, and we're now approaching halfway through 2021, and we're at $17.7 billion now, so another 7.7 in the last 12 to 18 months.
Some amazing statistics to share there with the audience. Well, moving on to the next question. We are sitting on unprecedented levels of global liquidity. It clearly has had impacts on the equities. How far do you think it has impacted the inflows into the ETF specifically?
Yeah, look, I think it's definitely clear that global liquidity has increased substantially over recent years. A lot of central banks looking to stimulate the economy, and there are some good reasons for that. That money has to find a home somewhere, and so with cash rates at next to zero around most of the world, people are looking for some form of return for that available liquidity, and therefore they're looking to make investments, and so that's had an impact you would suspect on asset prices around the world, all the way from property through to shares and most things in between. In terms of the impact of that on ETFs, well, look, at the end of the day, ETFs own a basket of underlying shares or a basket of underlying bonds or some similar asset, depending on the exact structure of each ETF. But if money flows into those shares, that increases the value of those shares, all other factors being equal, which obviously increases the value of the ETF. So the ETF is more the mechanism through which that people can make a simple investment into those shares, and therefore ETFs have benefited quite strongly because of their simplicity, transparency, low cost, etc., that I mentioned before.
Fantastic. It sounds like a really good introduction into the investing space. And I believe Betashares has recently introduced an interesting major Australia Bank hybrid index ETF. Hopefully we can talk to you more about that soon. So Betashares has recently filed an application for the country's first cryptocurrency-backed exchange-traded fund on the ASX as well. What is your take on the prospects of Bitcoin ETF on the ASX, please?
Yeah, look, I mean, it'll be very interesting to see. Certainly in markets overseas like Canada, where similar products have already been launched, they've been met with a wave of demand. Now, I suppose what seems clear to me, rightly or wrongly, is that there's a growing acceptance of Bitcoin in the market. And we're starting to see institutional investors in some instances making allocations to Bitcoin. We're starting to see many asset allocators talking about having an allocation to Bitcoin for the first time. So as that adoption grows, it's clear that it's becoming a more accepted asset class, arguably, than it was 12 months or 24 months ago. I think the important thing in terms of a Bitcoin ETF, if it does eventuate, is that at the end of the day, much Bitcoin volume and activity is occurring in unregulated markets, and if a Bitcoin ETF did ultimately launch in Australia, then it would be moving Bitcoin as an asset and a security into a regulated market environment, and one that would be easier for individual investors to access.
Exactly. I mean, a lot of the central banks are talking about introducing internet currencies, like, for example, the UK's Britcoin, and the US have also discussed it. China, I think, has even put it into trials. So it'll be interesting to see how these changes will affect the emergence of an ETF for Bitcoins or cryptocurrencies. So you've been bullish.
Absolutely.
Yeah. You've been bullish on tech ETFs. Can you tell our viewers why? As tech routes are currently casting dark clouds over the global equities, why do you support tech ETFs?
Look, at the end of the day, the way I think about this is that if we look around our daily lives, most people wake up in the morning to an alarm on their smartphone. They check their emails as soon as they wake up. They book their travel, whether it's for work or pleasure, online now. You don't call up an airline and make a booking on a ticket or call up a hotel, and restaurants, food, Excel for work and Word for things like we're doing now, talking on a virtual environment. Our lives are going more and more online every single day. And so as that technology is becoming a bigger part of our everyday lives, at the same time, it's becoming a more important part of financial markets as well, because at the end of the day, it probably makes sense when you think about it. People like investing in businesses that they use and businesses that they're familiar with. And so if you're using products and services from technology businesses on a daily basis, it makes sense that many of those people will feel comfortable making an investment in technology companies. And as more people make those investments, tech has risen to become somewhere around 20 to 25% of many global markets. And as that's occurred, it's now a more important part of the investment landscape. Now, I mean, it's not, as you mentioned, tech has sold off recently, and like any investment, you don't expect things to only go north. They will have their periods of outperformance and underperformance. But the reason for tech underperformance is pretty clear in my mind of recent times. And it's not because the adoption of technology or in many cases the earnings of those businesses have declined or gone away. It's simply that tech businesses are considered more a growth business, and therefore more of their future earnings sit 5, 10, 15 years down the track, as opposed to a mature business whose peak earnings are occurring here and now today. And so when you have a rising interest rate environment, which we're seeing around the world of recent times, that discounts those future earnings of growth companies and technology companies a lot more than it does mature businesses whose cash flow is peaking today. And so as a result, you've seen relative underperformance of technology against, say, value. in the market over the last 12 months or so, while those interest rates have been rising. Now, to my mind, the technology sphere isn't going away in time. Interest rates probably won't rise forever. So I do still see a place for technology in portfolios as a part of any diversified portfolio. But then again, so does value as another investment thematic as well. So it's about having a diversified portfolio, in my view.
Absolutely. They've proven to be the most buoyant historically, and tech has definitely proven to show some fantastic returns in investments. And you're absolutely right, the peaks and troughs are just part of the investment process, and that's what you have to keep your eyes on. So you have in the past talked about tech ETFs being diversified in nature, why it mitigates the company-specific risks. How far do you think that it would help in mitigating the sectoral risks?
Look, this is a fantastic question, and one I'm really glad I get the opportunity to answer, because you're bang on. At the end of the day, one of the benefits of ETFs is you're buying a diversified portfolio of shares in one trade. So let me use an example of a cybersecurity ETF. You can get access to 35 or 40 of the world's biggest cybersecurity companies in one trade. Now, that's good diversification at a stock level, like you said, because you may not know which of those 35 or 40 companies is going to do the best over the next few years. But if you own all of them and the thematic grows, then a rising tide tends to float all boats. And so that's the benefit of single stock diversification. But if cybersecurity as an overall thematic was disrupted overnight, not that I expect that, then that doesn't diversify your risk away from cybersecurity as a sector or a thematic. And so it's important to consider not only stock diversification, but also sector or diversification within a portfolio as well. But I will give you one example of technology diversifying an Aussie portfolio. So take, for example, the NASDAQ index, and NASDAQ has a zero weighting to resources and financials. Its biggest weightings are to IT and consumer discretionary, essentially. Now, if you compare that to an ASX 200 portfolio, the two biggest weightings in ASX in 200 are financials and resources. Well, you don't have any of that in NASDAQ, so you're not doubling up on the things you've already got. And what is two of the most underweight sectors in ASX 200? IT and consumer discretionary. Well, that's what NASDAQ's giving you. So by combining NASDAQ with an ASX 200 portfolio, you're actually blending sector diversification really, really nicely together. And so that's something we would encourage investors to really look at, because diversification, they call it the only free lunch in finance.
Exactly. Well put. And thank you so much for your insights. I mean, just that last question, that had a wealth of knowledge in that. And moving on, if you had to deploy the funds, where would you deploy them? Developed economies or emerging markets, and why?
Yeah, look, I mean, I've got a view here. I mean, I need to caveat it that I'm talking here about my own portfolio. I'm not an advisor, and I don't know anyone's circumstances, so they'll have to determine what's best for them. But in my portfolio at the moment, I like EM exposure. I think it's trading, generally speaking, on slightly lower valuations than some of the developed markets. But I also think that there's potentially a longer growth trajectory in some areas of emerging markets. So take something like Asian technology companies. To me, that's an emerging market thematic that's really the tip of the EM spear. And I'll give you one example of that longer runway of growth. At the moment, about 90% of the population in the US have access to the internet. If you go over to China, only about 60% of their population has access to the internet. And therefore, there is a longer potential runway for growth through adoption of the internet into the future within the Chinese market than the US market. So, on the basis of partly valuation and partly, certain areas with longer growth trajectories, I've allocated to emerging markets through Asian technology companies in my own portfolio.
Fantastic. Thanks for that. And I think the Australian federal budget is going to be allocating many funds into cybersecurity and improving the space for creation of jobs in cybersecurity and technology as well. So it'll be interesting to see how that will affect the growth in the sector. And
I'll just say very quickly on that point. Sorry, not to jump in too much, but we've seen over the last 10 years or so, technology has grown within the ASX 200 market from about 0.5% of the total market to about 4% of the total market. So that to me says there's still a lot of room for technology growth and technology to be a larger part of the Australian economy into the future. But it's also been a very strong multiple of growth, over the last 10 years from a low base.
Right, thanks for that. And I believe Betashares has also just recently moved into New Zealand. So it'll be interesting to hear, if you can add in at some point, how the New Zealand NZX differs slightly to the ASX in regards to the IT shares. And moving on to the next question, Betashares recently launched Cloud Computing ETF. How has the response been, and any numbers that you can share?
Yeah, well, look, the response has been very good because, people are seeing cloud computing play a larger and larger part in their lives every day. Whether you're starting to store your photos and your data and stuff instead of on your SIM card of your phone, you're storing it in the cloud, or people might log on to a small business owner might log on to an accounting software program like Xero and be able to do their accounting, not just in the office at their desk, but at home or on the bus or anywhere else. So cloud computing at the end of the day is the ability to access data anywhere, anytime, from any device. And so, it seems, fairly apparent that that's going to be a growth area part of the market, to me at least. And with that, the launch of the ETF has been very successful. For most new ETFs, you'd probably expect to see inflows of around $50 to $100 million in the first 12 months of that exposure. And we've had cloud computing in the market for about 3 months now, and it's garnered about $40 million of inflows in that period. So on that basis, you would say that it's certainly running ahead of the baseline expectations for a new ETF, and I'm excited to see where that one can get to.
Yeah, congratulations on those amazing numbers. And it sounds like you, Betashares, are definitely leaders in the ETF space for the Australian market. So I find that you've got a lot of education videos and tips on your website too. So a source of information for those who are interested out there. Head to the betashares.com.au website for further information. And the world's first inverse crypto ETF made a debut in Toronto recently. Till now, it has been mostly about bulls in the ETF space. With this, do you see more semblance in the ETF space as bears will also try to grab the market?
Look, I think it's certainly a possibility, and I'm sure there will be people who look to play a negative view on Bitcoin through an inverse Bitcoin ETF, for example. But our experience with our range of bear funds in Australia that provide a hedge against both the Aussie market and the US market is that the vast majority of trading, in fact almost the entirety of the flow we see, is there's actually been people looking to hedge their portfolios from market risk on a short to medium term basis. So they may already hold a direct portfolio of shares or ETFs or other managed funds, and for whatever reason they're nervous about the prospects for the market over the next 2 or 3 months, and so they look to remove some of that market risk by holding a bear ETF. So with some of the phenomenal gains that we've seen in Bitcoin of recent times, I wouldn't exclude the strong possibility, in my view, that one of the key potential uses for those products will be people who own Bitcoin have generated vast amounts of wealth from Bitcoin, and want to hedge out some of that exposure after strong recent runs.
Thank you very much for sharing your insights there. So more and more people are moving from actively managed funds to ETFs, which can be seen as more passive depending on the type of fund manager involved. Which one is better, in your opinion, and why?
Oh, you're asking me the hard questions now. No, it's only hard because I can't directly answer it, because I mean it's going to be different for each and every person, and I don't know their circumstances. But what I can share is certainly some stats and data around that. I mean, certainly we're seeing a large amount of inflows into passively managed strategies, particularly ETFs. Certainly that has been vastly exceeding any flows into actively managed products in aggregate. And there are a couple of reasons for that. First of all, in a lower interest, arguably lower return world, people are much more sensitive to fees, and passive products have generally been available at much lower fees. And that means more of the investment return stays in the investor's pocket rather than being paid to a manager. So that's certainly an attractive element of passive investing. But the other thing is, if you look at something like the report that's done globally by S&P, Standard & Poor's, they have the S&P Index versus Active report. And that looks at how many, what proportion of active managers are outperforming the index that they track after fees. And it's a very, very small number. And the longer the time frame you look at, the less likely it is that active managers will outperform their benchmark. So on a 15-year view, pretty much regardless of asset class, around 75% of active managers don't beat their benchmark. And that's a pretty astounding number when you're paying a high fee for professional management. So, at the end of the day, if you could guarantee yourself of owning an active manager that could beat the market, why wouldn't you do that? Of course you would. But the data and the stats suggest that finding that active manager, and for that active manager to consistently outperform, is very, very difficult and historically incredibly unlikely. And therefore, a lot of people are saying, okay, if I take the index approach, I'm going to do better in aggregate than 75% of active managers or thereabouts, and I'm going to save myself money in the process. So, each to their own, I suppose.
Exactly, you're spot on. That was quite a tricky question, but I think you navigated it very well. And fees would be at the forefront of any investor's mind, but I think also you raised the issue earlier about investing in things that are of value to people, that they are involved with. For example, tech's taking over our lives, so why wouldn't you want to play a vital role in investing in the development of products that you enjoyed using? So I think if investors read the product disclosure statements of the products that they use, consult with their funds managers and do their homework, as well as consider their financial situation, hopefully they'll have an educated manner in moving forward into their investment ideas and aggregates for the future. But I think we're heading to the end of our questionnaire now. If you don't mind, we'll move on. Last year, the US Federal Reserve's move to support credit markets and provide liquidity was an additional seal of approval for the ETF wrapper, as it chose to utilise ETFs in its buying program. Many other countries that were earlier reluctant are embracing the cryptocurrencies. Do you see go years ahead for fixed income ETFs at all?
Look, I think fixed income ETFs, have certainly grown hugely in popularity, and certainly the use of fixed income ETFs by central banks and other large institutions has certainly been a proof point of the value that fixed income ETFs can play in a portfolio. I think one of the important things to consider is in a low interest rate world, and I sort of touched on it in the previous point, but fees become increasingly more important. if you're looking at an expected return on a government bond that in Australia is around 2%, you can't afford to be paying away 80 basis points or 0.8% in fees. So being able to access a broadly diversified fixed income portfolio at low cost, I think is going to become increasingly relevant. I mean, the other thing with asset allocation is that let's take a balanced portfolio. People may have a slightly different view on exactly what balance means, but let's take a purist view and say that means putting half your money in growth assets and half your money in defensive assets. And we'll call growth, for this sake, for the argument here, shares, and we'll call defensive bonds, right? Over the last year, we've seen very, very strong rallies in share markets. So an investor who started the year at 50-50 would probably find that their portfolio has a lot more percentage weight in shares now, just by virtue of market moves, than what it does in bonds. So for them to move back to a balanced portfolio would result in selling shares and buying bonds to get the weightings back to 50-50. So I think after a strong rally in equity markets, it does set up a potential environment for flows into fixed income as people look to rebalance portfolios and maintain asset allocations over time.
Fantastic. I can see how the benefit of being more transparent is really prevailing here with the ETF space. And that actually is the end of our questionnaire. We've had some brilliant insights from Peter Harper today from Betashares. He's talked about the NASDAQ as compared to the ASX type stocks. He's talked about defensive against value stocks. So this interview has been so worthwhile. I thank you so much for your time, Peter. Would you like to share any final closing words with the audience?
Oh, look, I just wish everyone, the very best of luck and success on their investment journey. I mean, at the end of the day, we all invest because we're trying to put ourselves in a better situation in the future than where we are today. And I think, whether that's on behalf of ourselves or our families or those closest to us, it's a very admirable goal. And, we like to be there to try and provide not only the right tools that democratise investment for end users and give retail investors the same access to quality product that institutions have, but there's a lot of information, as you said, on our website and a lot of insights that we provide to the market, and we wish everyone a happy investment journey.
Thank you again for sharing your passion for the work that you do. It's very obvious that you feel strongly about it and enjoy what you do. So everyone, that was a wonderful show, and with that, 𝐳𝐧 will sign off, but please stay apprised and invest wise with 𝐊𝐶𝐤𝐿.